Is Exxon Mobil, ticker symbol XOM, a good stock to buy now? Welcome to Global Value. In today's video, we're performing a fundamental analysis of Exxon Mobil using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Exxon is worth in today's stock market. Plus, I'll share 2 special bonuses that could be the deciding safety factors when adding Exxon Mobil stock to your portfolio. Right now, Exxon Mobil trades for $112.68 per share. In the most recent day of trading alone, they're down 1.13%. However, since June of 2023, their stock price is up 7.3%. While this is positive, it lags the S&P 500, which is up more than 20% in this time. In the last 5 years, they're neck and neck with the market, compounding at 8.5%. But when we go back in the last decade, their stock prices only climbed by 10.5% overall. That's just 1% compounded annually. Still, since the global financial crisis, Exxon Mobil has compounded at 3.8% each year for shareholders. But their gains in their stock aren't their only returns. Right now, Exxon Mobil pays a 3.36% dividend yield. They're a dividend aristocrat who's grown their dividends for 43 years straight. They grew dividends 4.16% last year, and on top of this, they buy back shares as well. Today, Exxon Mobil has a 5.88% shareholder yield. Right now, Exxon Mobil is in the middle of their 52-week range. They're $27 above their 52-week low, and they're down $11 from their 52-week high. And how big is Exxon Mobil? As one of the largest oil companies in the world, they have a $449 billion market cap. At a talk at the University of Texas, Austin, super investor Monish Pabrai shared both his thoughts and the thoughts of Warren Buffett and Charlie Munger about Exxon Mobil as a company. Here's what he had to say.
Yeah, so I think both of them have been investors in oil and gas for a very long time. Munger made a investment in what was eventually one of his biggest mistakes because he didn't buy enough Belridge Oil in 1977. So, that's 46 years back. One time I was talking to him and he mentioned that he would love to have a investment in Exxon and be able to get a commitment from the management that they would do no more CapEx and they would simply run all the fields with the cash flows going to the shareholders. And he had calculated it'd be a tremendous investment.
Getting started with metric number 1, we want their average returns on capital to be greater than 14%. Over the long run, it's these returns that drive the gains for most companies. In fact, the average company only earns 7% returns, so we can build in margin of safety based on this being a higher quality business. Exxon's returns are going to swing with the price of oil and natural gas. These returns were low in 2019 and even went negative in 2020 as the price of oil went negative. But as the price of oil has rebounded and the company's cut some of its capital spending, Exxon's returns on capital have gone up as well. They spiked at nearly 26% in 2022 and are around 17% today. When they're averaged out over this time though, they only come in at 11.5%. While that's above average, it's below the 14% we were looking for. Because of this, it's an X on our first metric. What does the company all do? Exxon Mobil is an integrated oil and gas company that explores for, produces, and refines oil around the world. In 2023, it produced 2.4 million barrels of liquids and 7.7 billion cubic feet of natural gas per day. At the end of 2023, reserves were 16.9 billion barrels of oil equivalent, 66% of which were liquids. The company is one of the world's largest refiners with a total global refining capacity of 4.5 million barrels of oil per day, and it's also one of the world's largest manufacturers of commodity and specialty chemicals. In early May 2023, Exxon Mobil completed their acquisition of Pioneer Natural Resources. This was a $59.5 billion deal that more than doubled their acreage in the Permian Basin. There's been a lot of big deals in oil recently with ConocoPhillips and Marathon Oil merging, and with Hess being acquired by Chevron. Next, for an oil company, we want their sales and their free cash flows to have grown. Sales again depend on oil pricing, and in this time, Exxon's sales have gone up by 29%. What's great to see for shareholders is that their free cash flows have gone up by 6 times from what they were in 2019. These were negative again in 2020, but since then in the last 3 years, they've been very positive. Their big increases in their cash flows come from higher cash from operations while they've kept their capital spending around the same. In fact, they've even lowered this a little bit from 2019. Because of that, it's exactly what we want to see. This is our first check of the day on metric number 2. Right now, there are 7 super investors who own Exxon Mobil. This is led by First Eagle Investment Management, who has 3.49% of their portfolio in the business and who added in the most recent quarter. Longtime Buffett follower Chris Bloomstrand also owns the business as 1.23% of his portfolio. In all but 2 quarters in the last 6 years, he's either added or sold from the business. In our third metric for an oil business, we want to see that their shares outstanding are decreasing. Exxon's been buying back shares over this time, and even though they're diluting shareholders with their Pioneer acquisition, in the last 5 years, they bought back around 6%. That's what we want to see, so it's another check here. Metric number 4 puts our last 2 metrics together. We want to see free cash flow per share growth. Their cash flows per share have grown very well. They were up from $1.25 in 2019 to $8.26 at the end of 2023. Today, in their last 12 months, these come in at $7.98 per share. That's up more than 6 times from just 5 years ago. Another massive check here on metric number 4. Before we look at their balance sheet, it's time for our first bonus. Right now, ExxonMobil pays a 3.36% dividend yield. They've grown their dividends in each of the last 43 years. But are their dividends safe? Oil and natural gas are cyclical industries. Because of this, it means that in some years, Exxon is going to look really good when the price of oil is high, and in other years, they may look not so good when it's low. We want to see performance throughout a cycle, and in 2 of these years, in 2019 and 2020, Exxon was not able to cover their dividends using their cash flows. However, since 2021 and onwards, including today, these are easily supported, and Exxon has brought in more than enough cash flow to make up for these last 2 years. Maybe it wasn't the best decision to keep paying those dividends in those years, but things have worked out okay for Exxon. Their dividends are covered today, which is what we want to see, and it's a check on our bonus. In recessions, it's companies with too much debt that can have the biggest losses and even go broke. In our 5th metric, we want their net debt to be covered by their cash flows. In this time, Exxon has steadily been paying down their debts after they spiked at nearly $69 billion in 2020. These were down to $16 billion at the end of 2023, and today they sit at just $7.1 billion. That could be paid off with just 1/4 of ExxonMobil's current cash flows. In this time, they brought in $130.6 billion worth. That even includes 2020 when they had negative cash flow. It's a massive check here as Exxon knocks it out of the park. They fully support their debt loads and they can easily pay their dividends today. Next, why don't we figure out what Exxon is worth after we cover our last safety bonus? Ben Graham, the godfather of value investing and Warren Buffett's teacher, wanted to see a current ratio greater than 1.5 times. This is a key measure of short-term liquidity for how a company can pay its debts in a hurry. Exxon has increased their current ratio from 0.78 in 2019 to around 1.38 today. It's good that this is above 1, but it's just below the 1.5 times we wanted to see. This might not be a deal breaker, and there are reasons in the oil and gas industry that this could be possibly okay, but it's still an X on our bonus. Now, what is ExxonMobil worth? The big metric of them all, metric number 6, which is also today's first valuation, we want Exxon's average cash flows divided by their enterprise value to give us a yield greater than 5%. This would give us a risk premium to the 10-year treasury, and it's in line with the historical returns from the S&P 500. Today, ExxonMobil has a $464 billion enterprise value. That's what we get after we add their debt and their market cap together, and it helps us look at Exxon like it's a private company. In this time, Exxon brings in $26.1 billion in an average year. When we divide that by their enterprise value, today we get a 5.6% average yield. That's better than what we wanted, and even better than that, in their last 12 months, Exxon has brought in $32.1 billion of free cash flow. When we divide that by their $464 billion enterprise value, it gives us a 6.9% current yield, also above that 5%. This means it's a check on metric number 6, but don't just run out and go buy the business. Watch our next 2 valuations before you stay till the end for Exxon's final fair value and rating. Next, we're using a DCF valuation to give Exxon some credit for its growth. We're taking their cash flows and using historical assumptions to grow these into the future. It's up to you to do your own homework here. We'll assume that Exxon grows their cash flows at 5% in each of the next 10 years. Then in the following decade, we'll assume these grow at 4% annually. We're adding in their tangible book value to give an estimate of their net worth also. Today, if we wanted a market-beating 15% rate of return, which is what Warren Buffett wants from his investments, Then it looks like a DCF valuation for Exxon says it's worth $121.45 per share. That's up $9 from their current stock price, but please keep some key points in mind. Exxon's roughly trading a little higher than they have in the past 10 years compared to their median price to sales and enterprise to sales values. Yet the company is below their median enterprise to free cash flow values. They still need to keep these cash flows up into the future to be reasonably priced. Based on these past multiples and future growth assumptions, today a GF value comes in at $102.23 per share. That's down $10 from their current stock price, with some smaller growth assumptions for their future. Buffett likes the numbers from a company, but it's really its qualities that are his true love. Let's learn what these are for Exxon through a long and a short thesis, starting with the long thesis first. Number 1, Exxon has been very responsive to shareholder concerns. They've reduced spending, appointed new board members, they've increased disclosures, and announced emission reduction targets. Number 2, Exxon will likely see its portfolio mix shift to liquids as gas volumes decline and new oil projects start production. Cash margins should improve as a result, thanks to the Permian and Guyana volumes. And number 3, with coordination between upstream and downstream operations, as well as integrated refining and chemical facilities, Exxon achieves a high level of integration that creates value, as opposed to simply owning the assets. But things aren't all positive. Let's look at a short thesis as well. Number 1, Exxon lacks the level of investment in low-carbon businesses such as renewable power as its peers. This creates risks around reducing its emissions, and its future may not be as diversified as other oil and gas companies. Number 2, oil demands may peak and decline sooner than expected, meaning that ongoing investment may not have the same returns as in the past. And number 3, the acquisition of Pioneer may be value destructive for shareholders. It's a telling sign that Exxon paid for it using their shares, saying that their shares may be more overvalued today, especially as the company has access to plenty of debt and easily could pay that with cash. Now let's put everything together for Exxon Mobil. In our fundamental review of XOM, we learned they go 5 for 6 on the Select 6 analysis. They're also split 1 of 2 on our bonuses. The company earns higher returns than average, but still not at the level we wanted to see. It's also the case that they can meet their short-term obligations, but they don't have the safety metric wanted by Ben Graham. Still, Exxon has grown and they've significantly increased their cash flows in the last 5 years, especially in the last 3 years since 2020. They paid down a lot of debt and supported their dividend, but they did issue shares for their Pioneer acquisition. You could roughly expect an average performance from the stock going forward. Today, a fair value for the company comes in at around $111 per share. That's at their current stock price, $20 below their street target price. Exxon looks fairly valued. To find undervalued stocks, sign up for our investing tools and get exclusive bonus coverage of 89 stocks and counting.